Welcome back to Alpha Recap. We're recapping the biggest market moves from today, February 10th. I'm glad you joined us after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack from today's tape, from century bonds to company filings and some spicy active manager letters. It felt like a bit of everything in one trading day.
Let's start with the headline grabber. Alphabet marketed a 100-year bond and demand was intense. The US tranche was more than 5 times oversubscribed, and the UK piece followed. That sent a clear message about the yield hunt.
Yeah, investors were basically paying to lock in a yield for a century. It's not something you see every day. That's an intergenerational trade. People bought into perceived safety and the idea of locking financing costs for a very long time.
It's a striking sign that high-quality corporates had strong access to capital. But we also have to be blunt about the risks. Ultra-long duration can blow up if inflation surprises higher or if liquidity dries up. You're taking some real duration risk for yield.
Exactly. To put it simply, duration is how sensitive a bond is to interest rate moves. The longer the maturity, the more it moves when rates change. So buying a 100-year bond is betting that rates won't spike for a very, very long time.
And for a portfolio, even a small allocation to those ultra-long bonds can meaningfully raise your volatility if rates back up. It's great for yield if things stay calm. Terrible if inflation or policy surprises you.
There's also a debate among analysts about sustainability. Some see Alphabet's deal as a one-off because top names had very low term premia. Others think it might kick off a broader move to extend duration among institutions hungry for yield. I'm in the skeptical camp. It feels more like a sweet spot trade than a structural shift.
I'll agree with skepticism. Institutional flows could push more long issuance, but investors still have to match liabilities and liquidity needs. If you're not literally matching a pension or endowment timeframe, a century bond is a tough fit.
Switching gears, there was a cluster of 8K filings from companies like Coca-Cola, Datadog, and Pfizer. Those filings included Item 2.02, Results of Operations, and Item 9.01, Exhibits. Those exhibits are where the numeric details live.
And that's important. The index summaries that many feeds show often strip out line items. If you're a trader or analyst, you have to pull the exhibits to see revenue lines, margins, or surprise guidance. Those numbers can reprice a stock fast.
Take Coca-Cola as an example. It's rallied about 22% over the past year and sits with a market cap near $335 billion. If the exhibits showed margin pressure or slowing comparable volumes, that could change near-term sentiment despite the long-term brand strength.
Good point. For Datadog and Pfizer, event-driven traders should have been on alert. These 8Ks can trigger analyst updates and short-term re-ratings. If you trade on news flow, you should have had those filings queued up before the close.
30 seconds on how to read them. Item 2.02 means the company disclosed operational results or condition changes. Item 9.01 attaches exhibits like earnings releases or supplemental figures. Don't rely on summaries. Look at the actual exhibits, line by line.
Now the other narrative. Active manager divergence. We saw Ace River Capital's fourth quarter letter highlighting a holding in Vox Royalty that returned about 160% since purchase. Yet the fund posted a Q4 loss of about 4.5% and a full-year decline around 22%.
That's the classic concentrated bet story. You can have a couple of home runs and still be underwater if the rest of the portfolio got clobbered. It's a reminder that individual winners don't always offset broad exposure to cyclicality or macro shocks.
By contrast, Rowan Street Capital disclosed adding Tesla in the fourth quarter after their composite returned about 11% in 2025. While the S&P finished about 18%. That suggests managers hunting asymmetric upside to close the benchmark gap.
Right, and that raises a couple of questions for allocators. Are these moves genuine conviction, or are managers simply chasing momentum to catch up to benchmarks? You need clarity on position sizing, liquidity management, and downside controls before trusting that a pitch.
Exactly. And for retail investors trying to pick managers, look beyond a single winning position. Evaluate the mandate, concentration limits, and how downside risk is controlled. Those big letters are useful because they force disclosure on strategy and outcomes.
We also had a handful of quieter but still relevant stories. Target cut about 500 office and warehouse jobs to redeploy spending into stores. That's a strategic reallocation. Less overhead, more in-store investment. But it can create short-term implementation risks.
Exactly. Cutting jobs to invest in stores is a trade-off. It could improve the customer experience and margins over time, but during the transition, you might see disruptions. Retail investors should watch same-store sales and cost-to-serve metrics for the next few quarters.
There was also a small-cap headline. Branch Out Food projected $30 million in sales for 2026. Those projections are common, but for small caps, you want audited quarterlies or run rate evidence. Headlines alone aren't enough to commit capital.
Agreed. Demand proof before you buy into optimistic guidance. Look for gross margin trends, distribution expansion, and verified quarterly numbers. Otherwise, you're buying a narrative, not a business.
Another small note for legal risk-mindful investors. There was a class action notice for purchases in another big tech name between June the 12th, 2025 and December 16th, 2025. Litigation can be a long-tail risk and a volatility overhang.
So what did investors actually need to do after the close? The article laid out 5 strategic steps. First, read the exhibits. For every 8K flag today, pull the attachments and check the line items. Don't rely on summaries.
Second, reevaluate duration exposure. Alphabet's Century Bond was a market signal that investors were willing to stretch maturities for yield. Stress test your portfolio if you're tempted to add ultra-long credit, especially under higher inflation scenarios.
Third, distinguish conviction from headline. Manager letters can be informative, but you need to reconcile position concentration with your own risk limits. If a manager's results hinge on 1 or 2 names, ask about mandate drift and liquidity.
Fourth, treat small-cap projections skeptically. Require audited evidence or a verifiable run rate before increasing exposure to names like Branch Out Food. And fifth, monitor operational redeployments, like Target's cuts, because they can influence margins and comps.
Let's wrap with the bottom line. Today's tape blended a search for yield mentality with material corporate disclosures and divergent manager outcomes. Alphabet Century Bonds highlighted a willingness to accept duration for yield. Multiple 8T made fundamentals front and center, and manager letters reinforced that concentrated bets can both produce winners and leave portfolios underwater.
So the practical takeaways: read the filings, measure interest rate and legal risk against your horizon, and separate conviction from headline noise before you shift allocations. And if you're considering ultra-long credit, match it to your liability and liquidity profile.
Those are solid takeaways. Thanks for walking through all of that. Before we sign off, a reminder. If anything we covered today piqued your interest or you want the exhibits we mentioned, head to stockalpha.ai and ask us directly through the Q&A feature. We'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back with another Alpha recap after the next market close. Send your questions to stockalpha.ai and we'll dig into them on air.